In this video we are going to have a look at trading gaps, what causes them, how to interpret them, but most of all how to incorporate them in your trading style. And we're going to look at two examples. One is on crypto and one is on a regular stock. Guys, if you like the content, do me a favor, like, subscribe, click on the bell, click on all so you don't miss anything. Leave me a comment, share this video with your friends if you think this is useful. Without further ado, let's start diving in. Like I said, trading gaps, and here right away you can see one of those gaps. And you might be asking right away, wait a minute, crypto, is that circus going on for 24/7? Yes, that is correct. However, the future market for crypto, the one that's being traded in Chicago, is not 24/7. I think they are running 22 hours-ish a day, 23 hours a day, have a very short break, and in the weekend they are closed. But since that circus is trading for 24 hours, the difference between the close on Friday and the open on Sunday, that is what causes the gaps. So maybe if you've been longer around in crypto, you know these crazy weekend pumps and dumps. Well, those pumps and dumps cause gaps on the chart, just like the one that you're seeing right here. So the first example that I'm going to show you here is on the CME Futures BTC. And you can also see here when I'm moving my mouse, is that this was Friday and right here this was Sunday. So this is one of those weekend gaps. And I also made a huge block here to see how long it will take until price gets down to that gap. Because that's then right away one of the key takeaways in this video. And that is that these gaps, they are a lot of times a magnet to price. Price has not been here. It is just really a black empty space. There has been no buying, no selling. There has been no auction in that area. And most of the time, and maybe it's also a little bit of a self-fulfilling prophecy by now, is that price gravitates back to that area, closes the gap to offer buying and selling on that price level to then eventually rotate. Does it always happen? No, it doesn't have to be, and I'm also going to show you a few examples where it isn't. So here we have a gap. You can see the price is slightly tapping in and then just go higher. I extended it until the moment it gets filled, but you would see that sometimes it takes a long time. We go a little bit further here on the chart, and then eventually you can see that here now finally it gets filled. So that took quite some time. This was on the Sunday 24 and this was Monday the 4th, so it took more than a week. And you can see also that price is then filling that gap and then rotating back to the upside. Then right away it makes another gap right here, and you can see that actually one gets filled very fast. That's another key takeaway that I want to give you in this video. And that is that the size of the gap matters. Size matters, because if the size is very small, usually it gets filled fast and it is relatively insignificant for price or price movement. So the bigger the gap, the bigger the significance is. So small gap, small significance gets filled easily. A bigger gap does not, very important, does not always have to or will get completely filled. Matter of fact, if you have big gaps, then you also see a lot of times that they only get filled halfway. You might be thinking right away, okay, so what is small, what is average, what is big? There is not really a cold hard rule for this. What I am personally using is a gap somewhere between 0 and 2% is what I call small and is therefore insignificant, gets filled fast. You can also see the example right here. That was not so big. A gap from 2 to 5%, that is a medium gap that gets filled most likely. Price will gravitate back to it most likely. And everything above 5% is a very big gap, and that will also take a long time to get filled or maybe not filled at all. If you go further here, for example, you also see one of these very big gaps, and this was also medium gap in this case, 3.6%. And you can also see here Friday to Sunday, and then price just goes higher and higher and higher, and it takes a pretty long time eventually until it gets filled. We will go over the box later. I will just continue here on price, because in the meantime, of course, you just have a lot of weeks in between, and therefore also gaps. This is a very nice example right here. You can see again Friday to Sunday, small trading gap, price goes back up, closes that gap, and then go lower. The fact that the gap here is closed, a lot of times, or not always, but a lot of times, it can also offer a trade. That is the next key takeaway that I want to give you, is that I do not use these gaps to open a long or a short to eventually fill them, but I always use gaps as targets. So never to say we have a gap, therefore we need to close it, let's open a long or short, but just use them as targets. And once we fill those gaps, you can see the rotation to the other side, so that could also then right away be a short. Let's go a little bit further. Here you can see the gap gets filled approximately halfway, goes higher, and then comes back for completely fills it, and then you can see also it shoots here a little bit further, and eventually price goes back up again. Let's see another example that I have for you. This one gets filled quite fast, and this one takes also quite some time. So if you would say, okay, let's open up a short because we need to close the gap, then you can see that we're bouncing off here, you probably get stopped out, and you're gonna keep trying on shorting, then eventually it takes quite some time. But you can see here also no bounce from the gap at fill, it's just straight through, and then eventually it went lower. So it is not 100% guaranteed. There is no strategy that works 100%. It is not something like, oh, we see something in the chart and therefore it has to happen. That does not exist when you're trading, and so therefore you have to take this a little bit in consideration with other factors, of course, in the market. But it is a very nice way to trade towards you. Here you can see finally, months and months and months after this gap finally almost gets filled, then you can see then we're bouncing off. This was quite recently. This was the Trump pump and dump over the weekend about we're buying crypto. No, fooled you, not really. And therefore you can see this was a Friday, huge move to the upside, very big gap. Therefore very most likely price will gravitate back to close the gap. This is also a news event. Usually news events gets completely reversed, and you can see that we have this grind lower, lower, lower. There's no bounce of the closing of the gap. Price even goes lower, and then eventually we have this slight bounce. But the fact that this gap will get filled, that actually for me was a very high certainty. Well, for now I can go on and on and on about these gaps, but I just want you to understand a few key things here. And that is that I would never ever open a long or short just because we have a gap above or under us. Because as you can see, sometimes it takes a long time to fill. So how do I use gaps? Very important, always as targets. Gaps are just targets. That's important. That if you have your confirmations to get into a trade, let's say right here, and you're asking yourself, well, where should I trade to? First, I would say then these lows, and then really the close over the gap, or maybe even halfway. You will also see a lot of times price bounces off the 0.5 of that gap. So just take a fib retracement, place it from the top to the bottom, and then you can see a lot of times that it bounces off the 0.5. So I would never use it just to place a long or short, let's fill the gap, but always as a target if I have my confirmations here on the top to get into a short. Now, the fill of the gap, and if I have my confirmations then at the bottom of the gap, or at least the fill of the gap, can of course be bullish, can be bearish, that could be a long or a short. Yes, that is true, but only if the gap is completely filled and if I have my confirmation. So I'm not entering here a long just because we filled the gap. That is just an extra confirmation. So maybe I have, let's say, bullish divergence here on the chart, and therefore I'm saying I'm entering here a long trade. We also, by the way, closed the gap. That is my extra confirmation. Let's enter a long. Or I see, let's say, a bullish CVD right here at the gap close. Great, then I'm entering a long. There could all be all kinds of scenarios, but again, just to say let's trade it towards because we need to fill or close the gap, that it's in my opinion not the right way to do this. Now let's quickly look at one stock. I think Tesla actually is Netflix I think actually is a very good example, because stocks can also have gaps. However, they are not traded on the CME futures. They are just traded on the quote-unquote regular stock exchanges, so let's say the S&P 500 or the Nasdaq. But they also have these big gaps. How is that possible? Well, these big gaps are not being created by the CME futures, but also by usually news-driven events. For example, earnings, and that is a big one. Once these companies come out with earnings and they are better than expected, worse than expected, then usually you see a big opening gap. And that is then of course also here, very simple, just the difference between the open and the close of the previous day. Here I have two very good examples. Here Netflix missed the earnings, so they were way worse than expected. It was right in the time when Amazon came up and Disney and all kinds of competitors. And imagine that you go to sleep here, your stock is trading at $500. The next day you wake up, the earnings after the close of the bell were bad. It crashes down 20% and now your stock is only worth $400. And this was a huge gap, 20%. I said this is way too big not to get filled. Well, you can also see here that price is trying to fill that gap to at least get something of a bounce. I wouldn't be surprised if it's slightly under half. Oh, look at that, exactly half. Wow, precision. You cannot make this up. Look at this, 0.5 of the fib retracement, absolute perfection, and then we're gonna go down. This gap could have stayed open like this because now it is a big gap, okay? B, does it need to get 100% filled? No. Does it a lot of times get 50% filled? Yes. Do we gravitate back to the big gap? Yes. So actually all conditions here are met. So if this would have stayed open, I wouldn't be all too surprised. It is, by the way, a pretty big move to the downside. And guess what? The quarter after, the exact same happened. They again missed the earnings and again had a big drop to the downside. This time almost 30%. Also here, way too big not to get touched or not to get filled. Now, because it is such a big gap and you have such a big move to the downside and it was so significant at the time, it also takes a long time before it gets completely filled. We're months and months and months later, and just the time that spends inside of the gap, you're already talking about approximately 100 days. So the bigger the gap, the more time it will take to eventually fill that gap. Okay, let me quickly zoom in here on the 1 hour. Because this is also a good example that gaps do not always need to get filled. This is again an example of, let me see, October. I'm pretty sure that this was earnings again. We're now much further in time. This was approximately 12%, and I guess that the earnings here were way better than expected, and you can see the price is opening with the gap up. And if the performance of the company stays way better than expected, then a lot of times the gap just does not get filled. So you can also see here, again, this is a great example. It's not a golden rule. It's not a must. There's no one saying we need to do this or have this. So you can see the price never gravitated back to even the half back of this gap and just went higher and higher and higher. And guess what? Almost a couple quarters later it happened again, and this is on January. I'm also pretty sure that these are earnings. You can see that this one is also still open, but this one, for example, right here got completely closed. There was not even a bounce here of the 50% of the gap. This thing just went completely filled, and it just went higher and higher and higher. So this actually would have been a nice target if you were trading this. And you have your confirmations here at the bottom that you would say, you know what, I'm entering along here for reason ABC, and then we're just trading it higher. Within this, look at this, actually a great example. Within this, you can also see these smaller gaps right here. Those really are the gaps between the trading sessions. So this was Tuesday. Look at what's at the bottom of my screen. This was Tuesday. This was Wednesday. So this is just an opening gap between the trading sessions within the week. Very small, very insignificant, gets filled very fast. You actually do not really have to take this into account because most likely you also not get a bounce off the close of this gap. There's just not a whole lot that's happening. It will not get back tested. It really does not matter that much. And having these small gaps right here on your chart when you're trading stocks is something that you see pretty much on a daily basis for a lot of companies, and especially these earnings, these news events. Something that really is important in the industry of what happens in the world. That is what causes these huge gaps to the upside, to the downside. And let me see where we are right now. Here we also still have a gap open. I think this one never got tapped. This is actually a nice example of also a very big gap. Here, also here, no bounce of the 50%, just completely filled here to the bottom, slightly further, and then actually we had a bounce. So if you would have, and I would never trade this, but let's say you would have said, I am going to take a long trade from this level right here and I'm putting my stop loss underneath this low, then actually it would have been a great trade. Again, not something that I would trade, but that could be a idea. So to summarize it, our big gaps have a high chance of getting tapped halfway or completely. Sometimes you see a bounce at the end of the gap. I would never place orders there, and I will always use gaps as a target and not just to place long and shorts because we have to fill them. You saw a few examples where we don't fill them at all. You saw a few examples where you bounce from the 50%. So it really depends a little bit. I always see it more as in context, but I am always aware if there are big trading gaps, would it be in crypto, would it be in stocks, that I need to take them in account for possible targets. Do you agree with me or not at all? Please let me know in the comments. Also, if you find this video very useful, I'll be very appreciative if you leave that in the comments. Thank you guys so much. Also like the video, subscribe, click on the bell, click on all so you don't miss anything. See you in the next one. Bye bye.